Unit 10 will cover chapters 10 and 11, and we'll continue to work on case study 2. You also will need to present your team's project status report number 2 this week, and you'll be continuing the case study 2 work. In chapter 10, we'll cover financial statements, and we'll cover forecasting financial requirements, 2 very important topics for us to talk about as far as being entrepreneurs and operating our businesses are concerned. Okay, kids, we're going to talk about our financial statements this week. This is chapter 10. And we'll get into the 3 primary financial statements. That's be the income statement, the balance sheet, and the cash flow statement. That's these 3 items located on the bottom of this chart right here. So as we begin to learn about these financial documents, we learn that they can explain to us a lot about what's going on within a company, and they certainly can give us clues as to what we ought to be exploring more in depth in order to determine how a company is operating. So 3 very important documents: the income statement, the balance sheet, the cash flow statement. Anytime that you hear me talk about a company's financials, that's what I'm talking about right here, those 3. So first, let's look at the income statement. The income statement is a report showing the profit or loss from a firm's operation over a given period of time. So we ask ourselves, how profitable is the business? And the basic equation, excuse me for that, the basic equation for solving the question of the income statement is sales revenue minus expenses equals profits or income. That's why we call it an income statement. So the basic equation that the income statement addresses is this one right here: sales less expenses equals profits. Pretty simple, right? And so this is what we're going to talk about for a little bit. And that includes a lot of things. You see that list of items underneath the equation there. The revenue is from product or service sales, cost or the cost of producing that product or service. Operating expenses are all of the non-cost of producing items: the marketing, the selling, the G&A, the expenses, and the depreciation. And then we have financing costs or interest costs, and then tax payments. So you'll see that in every income statement, whether it's a small company or a large company. Now let me also point out that the income statement measures company performance over a period of time. This chart just keeps popping up all the time, and I need to get that stopped. I'm going to hit that button right there. Okay. Excuse that interruption. So the income statement measures performance over a period of time, and it answers the question of sales less costs. And you see the costs that start right here all the way down, and then that equals profit. So let's see what these costs are. Well, first we have the cost of goods sold. Sometimes you hear these called direct costs. This is the cost of producing or acquiring a product or service. And when I subtract that from the sales, I end up with a term called gross profit. Now I'm going to go through each of these because I want you to learn these terms. When I subtract from that the operating expenses, that's the marketing and selling, the general and administrative, sometimes you'll hear us call this G&A, and depreciation expenses, that then equals the operating profits. This is an important number right here. A lot of our financial analysis hinges on this number right here. That gives us our earnings before interest and taxes. Then from that we get the operating profits. That's what you see at the top of this column right here. So when I subtract the operating expenses, I get operating profits. And as a matter of fact, this same block. I subtract from that the interest expense. That's the cost of borrowing whatever money I have borrowed. That equals my profits before taxes, or my earnings before taxes, EBT or PBT, less the income tax equals my net profits, or my net earnings. So you'll hear those terms kind of used interchangeably. So this is the basic structure of an income statement. This is the structure of any income statement of any company in this country that you will see, whether it be a very large company or a small company. Let's look at it a little bit differently. You can break it up into operating activities and financing activities and taxes. On the operating side, you see the cost of production and the cost of marketing, selling, and G&A, and depreciation. And all of that ties to sales and gross profit and operating income. On the financing side, you see the interest expense. That's the cost of borrowing whatever money you had to have, and that gives you earnings before taxes. And then you subtract the taxes, and you get the net income that's available to owners. So it's kind of a little bit of a different way of breaking up the income statement to take a look at it. Here's an example of Pendley and Associates. This is Exhibit 10.2 in the text, and you go through this, and you can see all these steps that we just talked about unfolding here. It had sales of $850,000, ended up with net profits of $60,000. You can calculate that percentage pretty quickly, can't you? It's less than 10%. And that's pretty typical of most companies today. Down at the bottom, I want you to see something, though. We had some net profits, $60,000. We decided to pay $15,000 in dividends. What happens to that money? I'm paying $15,000 in dividends, and now I'm going to have some retained earnings, $45,000. Well, what happens to that money? So let's see what happens to this money. We're going to talk a little bit now about a balance sheet. This leads us right into a discussion of the balance sheet. This is a report that shows a company's assets and its liabilities and the owner's equity at a specific point in time. Remember that. The balance sheet measures performance at a specific point in time. Now, given that the income statement measures performance over a period of time, how many balance sheets do I have to adequately compare the numbers between the two financial statements? Obviously, you got to have two balance sheets, one at the beginning of the period, one at the end of the period, and now when I look at those changes, I've got the changes that I can use to interact with my income statement. So the basic equation that the balance sheet satisfies is total assets is equal to debt or total liabilities plus the owner's equity. And that's the amount of money that the owners have invested in the company plus any accrued retained dividends that they have, or retained earnings that they've collected. So here's the graph, or the kind of the picture image of the balance sheet. You can see on the left-hand side we have assets. On the right-hand side we have debt and equity, or liabilities and equity, or liabilities and net worth. You'll see all those terms bandied about for balance sheets, but the term I will use on the right-hand side will be liabilities. It'll either be the current liabilities or long-term liabilities. And then we'll use equity for the ownership portion. So you see here on the asset side we have current assets, that's cash, accounts receivable, and inventories. Then we have fixed assets, that's machinery and equipment, buildings and land. Then other assets, which are long-term investments or patents or any form of intellectual property could go in here if you can put a value on it. So we add all those up, and that's total assets. Now, on the liability side, I have short-term liability, or the short-term debt or current liability. You'll hear all those terms used there. That includes accounts payable, accrued expenses, and short-term notes. Short-term note would be a note that's due in less than 12 months. Now, accounts payable becomes, that's a result of all the credit that we've given to our customers. So when we give credit to our customers, what that means is you sign here, you pay in 30 days. I'll carry an accounts payable for at least that 30-day period before I get paid. When I get paid, then I can reduce that accounts payable. Accrued expenses are things like compensation accruals or tax accruals that I have collected but I haven't paid yet. Those are all called accruals, accrued expenses. And then short-term notes are just notes less than a year long that I make for whatever reason in my company. The long-term liability, or the long-term debt, is any long-term notes or mortgages that I might have outstanding. And then on the bottom side of the liabilities block is ownership equity, and that consists of three components. Well, really two components, I guess. We'll see more details on this in just a minute. It consists of the owner's net worth, or the partnership equity, or the common stock equity. And the owner's net worth, you'll see in a moment, is the owner's original investment plus any retained earnings that have gone in to that bucket, the equity side. So if I add those together, that's the total liabilities and equity, or total debt and equity, and that has to balance out to total assets. So you see the balancing aspect. This assets balance out with debt and equity in a balance sheet. All right, let's look at some definitions now. Assets that can be converted to cash within the firm's operating cycle are current assets. That's the way they're defined. And I want you to know something else. Recall in Chapter 22, we talked about net working capital. Net working capital we defined was current assets less current liabilities. Well, current assets then becomes our working capital. That's not the net working capital, but that's our total working capital. So that consists of cash, accounts receivable, and inventory, all three components of the firm's balance sheets, okay? So that's current assets, and that's the working capital that we have in our company. The net working capital would be current assets less current liabilities or current debt. Now let's look at the working capital cycle in summary one more time. Remember in Chapter 22 we went through this in a lot of detail, but recall now, when we purchase or produce inventory to be sold to customers, we sell that inventory eventually. We either sell it for cash, sell it on credit. If we sell it on credit, that becomes an accounts receivable, and then we have to collect those accounts receivable before all of this goes into the cash bucket. So if we sell for cash, the money goes in the cash bucket. If we collect accounts receivable, the money goes into the cash bucket. So you see here that what we're really talking about is that the working capital cycle is a key way that we manage our cash in our company. Some more definitions for you. Fixed assets is kind of important right here. Fixed assets are the plant, property, and equipment that you have in your company. They're kind of permanent type resources or assets. Depreciable assets are assets whose value declines over time, and it could be some of your fixed assets falling into this bracket. Gross fixed assets are the original cost of depreciable assets before any depreciation expense has been taken. And accumulated depreciation is a total depreciation expense taken over the asset's life. And oftentimes you'll see those assets depreciated over a 3, 4, or 5 year period, which means that depreciation during that period of time is pretty heavy if that asset has a big value. Then the term net fixed assets, that's the gross fixed assets less accumulated depreciation. You always have to evaluate fixed assets based upon their depreciation. Now, other assets that you remember seeing on the balance sheet were assets other than current assets and fixed assets, and oftentimes they'll be what we call intellectual property, patents, copyrights, and goodwill that have an estimated value to the company. Let's look a little bit now at debt or at liabilities. We have two types of debt, two types of liabilities. Current liabilities or short-term liabilities, which consist of accounts payable, accrued expenses, and short-term notes. And you can see the definitions there for each of those. Then we have long-term debt, loans and mortgages with maturities greater than 1 year. So that defines for us what is a current debt on a balance sheet. If I turn to a balance sheet and I see short-term or current debt, I know that that's debt that will become payable within a year, within 12 months. Anything outside of that stays in the long-term debt bucket. A mortgage, a very simple thing, is a long-term loan from a creditor for which real estate is pledged as collateral. This is typically a bank operation. Most banks require pretty good collateral to make these kind of loans. Owner's equity. Let's talk about that. That's a term that's bandied about quite a bit. That's the money that the owners invest in the business. So owner's equity has two components. It has the initial investment, and then it has any dividends that have been accumulated over periods of time. So I want to compute. Well, here's retained earnings. It's profits less withdrawals or dividends over the life of the business. So anytime I make a profit and I decide to keep some of that profit for retained earnings, then that goes into my equity bucket in the balance sheet, and it begins to accumulate. And that's how an entrepreneur increases value in their company, by running up that equity number. So owner's equity is equal to the investment plus any cumulative profits that you can show, less any cumulative dividends paid to owners. So that's the owner's equity in the company. Now here's an example of balance sheets for Penley & Associates. You see 2010 and 2011, and on the right-hand side are the changes column. And now why would we do that? Well, the reason why we do that is that we want to have an apples and apples comparison between the balance sheet and the income statement and the cash flow statement. So here you see 2010, 2011, when I take the difference of those, that's the change column right there, and I can now see what's happening in my balance sheet operation. Look down toward the bottom there. You'll see the current liabilities or current debt, we've called it, accounts payable, short-term notes, total current liabilities, and then we break out the long-term debt. These are the big guns. The long-term debt then would add to the current debt or current liabilities to give us total debt. Then we can begin to break down ownership equity if we need to do that. Nevertheless, here's our total debt and equity columns here on the balance sheet, and I take these two balance sheets so I can look at the changes in the balance sheet over that period of time. So here's a good diagram of what we were just talking about. An income statement reports the profits from January 1st to December 31st of a year. The balance sheet then would have a statement on December 31st and a statement again on December 31st, 2011. And you can see that the balance sheet has collected information over that period of time. So the balance sheet reports the firm's financial position at the beginning of 2011 and then reports the firm's financial position at the end of 2011. A financial report showing a firm's income or cash when it is received and expenses when they are paid is called a cash flow statement. The cash flow statement simply measures the cash flows coming in and the cash flows going out of a firm. So it includes cash flows from normal operations. This is the operating activities. It includes cash flows related to investment in sales or assets. This is the investment activities. And then it includes cash flows related to financing the firm. That's the financing activities. And you will see here in just a moment we're going to provide you some kind of examples of cash flows. But in every cash flow statement that you see, you'll see these three sections in the cash flow statement: the operating activities, the investment activities, and the financing activities. So even on the largest companies, they'll break them down this way. And so that's our clue now to begin learning, well, what are some of the things that we really need to be aware of here as we go forward. So we want to measure our cash flows daily, and that generally, speaking, we'll set up our business to do that. We want to look at after-tax cash flow. That's our adjusted income. And then we want to look at our net working capital. That's the money invested in current assets plus accounts payable and accruals. Okay, so that's our net working capital. So those are kind of the things that we monitor all the time from a cash standpoint in our operation. And we'd like for the cash flow statement to help us predict when we're going to have a negative situation so that we know when to add money into our bank accounts. So cash flows from investment activities, that's the cash inflows and outflows resulting from the sale or purchase of equipment or another depreciable asset. And cash flows from financing activities is the cash inflows and outflows resulting from paying dividends and interest expense, increasing or decreasing short-term and long-term debt, issuing or repurchasing stock. Now, when we look at computing cash flows from assets, there's an equation down at the bottom of the page. I really want to focus on that. I've got cash flows from assets, and I want to measure what my after-tax cash flows are going to be, because this becomes important for me as a company operator. So cash flows from assets is equal to the after-tax cash flows from operations. That's the cash flows left when all tax money has been either carved out or sent off. And we subtract from that then the investments in the operating working capital. Remember we talked about that. And we subtract from it investments in long-term assets. These are some other cash flows you can look at. After-tax cash flows from operations, you see the equation there. Operating working capital. This is something that's an important number for us to monitor as managers and owners and operators. Our operating working capital is equal to the current assets minus the accounts payable and accruals. Be a little bit careful here because you'll see a term called net operating working capital. And you got to be just a little bit careful in how you use those, because sometimes this thing here called operating working capital will be the same thing as net working capital. So be just a little bit careful there. In Chapter 22, we define this as net working capital, NETWORKING. Now here is a cash flow statement for Penley Associates at the end of December 31st, 2011. And you can see here that there's the three activities, operating activities, and you can see that's the sales and costs, and you see what goes on here. So we end up from that with our cash flows from operations of $50,000. You know, not too bad. Then we had our investment activities. This would just simply be this item over here. less the gross fixed assets. So anything that we bought or purchased, that would be our investment activities. Any asset that we added to our asset base, or any new equipment or buildings or whatever would go into this pot right here. Financing activities includes short-term notes, increase in long-term debt, that debt less the dividends to pay the owners, and financing cash flow. We're going to talk some more about that in just a moment, about dividends. So then we see that if I go through this cash flow statement for Penley and Associates, I start out with the net profits of $60,000, and I add back in depreciation. So I kind of go through this process here of looking at what's happening to my cash, adding and subtracting the various components, and I come up with a conclusion here that says I'm going to have an increase in cash of $5,000, and there's probably a good chance I will not have to invest money at that time. Now, on cash flows from financing, here's another way of saying it right here. I said increases in debt, that's input to the cash. Increase in equity, that's input into cash. Interest and dividends paid to investors, that's an output from cash. Decreases in debt, outputs from cash. And then decreases in equity is another output from cash. So you can see kind of the center of the world here in our operations is really our cash flows and our cash flow financing. Very, very important that we understand that concept. So here's some general factors impacting the firm's financial situation. If you're looking at a firm, you're trying to decide, does this firm have a long-term future, and all those things that you ask yourself when you're looking at one. Here's four questions here that you're going to ask. What is the company's ability to pay its debt as they come due? That's always a question that a good accountant will ask. What is the firm's profitability from assets? Has it been making money off those assets it's been delivering? And what is the amount of debt the business is using, the total amount? And then you look at the rate of return earned by the owners on their equity investment. So those are just some kind of things that you look at when you're looking at a company. Now let's look at some common ratios. I'm not going to bore you with all these details, but I'm just going to say this. Here's a set of common ratios that oftentimes investors and owners will do a ratio analysis to try to determine how their company is doing. So take a look at these ratios. They're kind of standard. Look at number one there. That's the ability to pay debt as it comes due. I'm going to look at the current ratio. And Penley & Associates is 3.5. The industry norm is 2.7. What we can say here is there's definitely an issue of some sort because our current ratio, and it's really a positive issue in this case, our current ratio is higher than the industry norm. You would like anything greater than 1 would be okay, but if you can get it above 2 on the ratio, that's even better. Company's profitability on assets, you can go down through these and kind of see what's happening with respect to the company. One thing you can look at is the return on assets and the total asset turnover. Those are kind of important factors as to the profitability of the company. The amount of debt the company uses is the debt ratio is what we call it. It's total debt divided by total assets. Here you can see this company is in pretty good shape because its debt ratio is less than the industry average of 40%. Now, I want to go back up to operating profit margin just for a little bit. In this case here, the operating profit margin is just a little bit above the industry norm. And so that's not necessarily bad, but it could be bad because you've got to stand back and say, what is it that we're really doing here that's different, and is it going to have a long-term impact for our company? So it's important to kind of understand what all these ratios mean to you from a comparative standpoint. Here's a little diagram that simply says we're looking at return on assets. So I invest some capital, I then acquire some assets, and that capital and the cash and the assets become my total assets. I then produce something and I sell it, and I can begin to get profits and cash flows. And then those determine what my return on assets is going to be, and that's equal to my operating profits, remember that term, and my divided by my total assets. Now, let's switch from that conversation into something you're going to hear me say quite a bit. Pro forma financial statements. What this means is that these are statements that project a firm's financial performance and condition. Look at that term, project. So with pro forma financial statements, we're trying to project what we think our finances are going to be doing in time that's yet to occur, time of the future. So those are pro forma statements. Well, what's their purpose? We want to see how profitable the company can be, what our future cash flows will be, and how we plan for that. What kind of financing may we have to have. That's another thing that a lot of young folks and companies don't understand is that once I discover that I need some cash, it's too late really to go work the financing component. I can only take advantage of some of those things that I maybe don't really like that much. So it's important that a business owner, a business operator look ahead when it comes to cash flow. And once you see that there's a cash flow dip that you really don't know why it's occurring, but it is occurring, then you get some short-term note money to allow you to operate through that period of time. Okay, this concludes Chapter 10. It's a good little chapter. Understand that when I say a firm's financials, I'm talking about the income statement, the balance sheet, and the cash flow statement.